Your bank balance is not what you think it is. That sounds dramatic, but it is plain mechanics, not folklore. If everyone tried to pull out cash at once, the structure would fold within hours because the notes and coins do not exist in anything like the amounts displayed on screens. That fragility is not a malfunction. It is the blueprint. We live in a system built on fractional banking, an architecture so old and polished that most people no longer notice it. It is the quiet motor behind credit booms, rising prices, and the staged appearance of effortless wealth. Once you study the wiring, you see that money rests on promises that cannot all be satisfied at the same moment. By the way, if you love money, subscribe to the channel and give it a like. Now, let's continue. To trace the pattern, step back to an era before apps and instant transfers. In medieval Europe, money meant metal, gold and silver you could weigh. Merchants and nobles kept trunks of coin, but travel with treasure invited knives and ambushes. Goldsmiths owned solid vaults, so people stored their metal with them and received a paper receipt, a bearer claim redeemable for the same amount of gold later. Those receipts soon circulated in markets. Traders found it easier to pass around a slip of paper than sacks of coin, and as long as the smith had the metal to honor redemptions, the slip functioned as well as the metal as long as confidence held. Here is where the pivotal trick emerged. Goldsmiths observed that depositors rarely arrived together. Out of 100 clients, only a handful would ask for metal in a given week. The rest slept safely behind locked doors. Seeing that slack, the goldsmith issued more receipts than there was gold in the cellar and lent the extras at interest. As long as claims did not hit the counter at once, the deception worked. Paper multiplied beyond metal, profits multiplied with it. Value had been conjured from ink and belief. Banks institutionalized the habit. By the 17th century, states discovered its power. The Bank of England, founded in 1694, did not exist to run savings clubs for shopkeepers. It existed to fund the crown's debts from war. The bank extended credit in sums that dwarfed its coin, and the government pledged the taxpayer's future as repayment. The formula never really stopped. Modern treasuries still borrow balances that banks create with keystrokes and commit future citizens to pay the interest on those balances. America followed the same arc. Early banks issued notes redeemable in specie, then learned the profits of overissuing claims. Panics revealed the gap. A rumor would spark a line at the teller window, and the vault would soon prove too shallow to pay everyone. Institutions toppled in days. Instead of scrapping the arrangement, lawmakers built a safety net. Central banks took shape as lenders of last resort, public backstops to preserve belief when the cash could not possibly cover the claims written against it. Translate that old rhythm into modern plumbing. You deposit $100 and you picture a clear stack labeled with your name. In practice, the bank keeps a thin cushion and repurposes the rest into loans and securities. The classroom story used to feature a tidy reserve, ratio keep 10, lend 90, then repeat as recipients deposit and re-lend. That loop seemed to turn a simple 100 into almost 1,000 in deposits across the economy. The hidden catch was that only a sliver was cash. The rest existed as debts and ledger entries that depended on borrowers paying on time. Now the twist. In the United States, mandatory reserve ratios for many deposits have been set to 0 since early 2020. The neat multiplier is no longer the brake. So, what stops banks from lending boundlessly? A different leash, capital and liquidity rules written under the Basel framework by regulators meeting in Switzerland. These standards do not ask, did you keep 10% of Sam's deposit in the vault? They ask, do you have enough shareholder equity to absorb losses and enough high-quality liquid assets to survive a storm? The riskier the assets, the more capital the bank must post, and the more liquidity it must show it can raise in an emergency. That shift flips the simplistic story. Banks are not warehouses that lend out a pile of deposits. They create deposits when they lend, approve a mortgage, and the bank types numbers into the borrower's account. Those numbers are new money inside the banking system, born because a customer promised to repay. After the loan is booked, the bank ensures it still satisfies the Basel yardsticks. If it falls short, it raises funding, sells assets, or limits growth. The result is that most money people use daily is bank money, not central bank notes or reserves balances manufactured in the act of lending. This design has unavoidable consequences. First, structural inflation pressure. When credit grows faster than the output of goods and services, purchasing power drifts downward. Not every price wave is caused by banks, but the background tide runs that way. Second, perpetual debt. New money arrives as a loan with interest, which means someone must refinance, someone must default, or someone must borrow more, or the system would contract painfully. Third, concentration of advantage. Banks earn interest on balances created at a keyboard. Governments tap the system to finance themselves without immediately hiking taxes. And asset owners benefit as inflation nudges valuations upward while wages chase behind. When confidence slips, the curtain lifts. In the early 1930s, depositors demanded cash and discovered the metal wasn't there. Thousands of banks failed. In 2008, credit had been layered into mortgage securities upon mortgages. When defaults rose, funding markets seized up, and the whole web lurched. Central banks and treasuries responded with guarantees, rate cuts, and trillions in emergency support. They did not rescue a single villain. They rescued the machine that underpins day-to-day transactions, because without it, payrolls do not clear and trade does not settle. Look abroad to see variations on the same theme. In the euro area, Britain, Canada, and Australia, reserve ratios are symbolic. Basel capital and liquidity rules carry the weight. In China, India, and Brazil, high reserve requirements still help steer lending, but Basel overlays the same language of risk weights and equity buffers. Wherever you live, the leash on money creation is not piles of deposits in a basement. It is a spreadsheet of ratios negotiated in Basel and enforced by national supervisors. Here is the unsettling implication. The machine cannot run if everyone pays off every loan at once. Because bank deposits mirror outstanding bank loans, mass repayment would erase deposits and shrink the money supply. Spending would stall, layoffs would follow, and the system would convulse. The model depends on your participation, your willingness to borrow, to spend, and to treat digits as dependable value. You are both the fuel and the collateral that keeps the wheels moving. So, what can a person do? Start by separating money from wealth. Money is a claim. Wealth is capacity. Wealth looks like productive assets, valuable skills, reliable relationships, and knowledge that cannot be inflated away. Next, use debt deliberately. Leverage can pull future progress into the present, but it also hands your future cash flow to a creditor, and the rules are written with the creditor's safety foremost. Finally, assume that mild inflation is the baseline, not a surprise. Plan for a world in which each year asks you to run a touch faster just to stay even. This is not a call to bury currency or retreat to a bunker. It is a call to understand the plumbing. A checking balance is not a hoard of bills. It is a bank's promise. That promise is sound so long as the bank is solvent, liquid, and supported by confidence and a central bank backstop. If you want resilience, diversify the ways you store value and the skills you can sell. Hold some liquid savings for shocks, but invest time and money into capacities that compound even when credit cycles turn against you. History is a guide here. The over-issued receipts of medieval vaults, the 19th century runs, the Great Depression implosions, the 2008 mortgage spiral, each verse rhymes with the last. In every case, credit swelled beyond what incomes and collateral could carry. Then trust snapped and the air rushed out. Each time, authorities patched the hull and pushed the ship back to sea, because the modern economy cannot function without the engine of bank-made money and the belief that those digits will be honored tomorrow. The next rupture won't look identical. It could start with rate swings that shrink the market value of safe-looking bonds, or with losses in real estate or in the shadow banking world where non-bank lenders live. It could flare as a viral rumor that triggers a digital run, faster than any line of the past. What will matter, as always, is belief. Do people trust deposits, and do institutions trust each other enough for payments to clear? If that trust wobbles, policymakers will flood the pipes with liquidity again to keep the gears from seizing. To make the picture concrete, separate base money from bank money. Base money is central bank currency, paper notes, and the electronic reserves that banks hold at the central bank. Bank money is your deposit. You can swap bank money for base money only to the extent that the system has cash and reserves ready. In normal times, the difference is invisible because payments settle inside the banking network. In a crisis, the difference becomes violently visible and painfully educational. Consider a simple mortgage. A bank approves Lena for $300,000. The bank does not rummage in a chest. It credits Lena's account, creating a new deposit and a matching loan. Lena pays a seller who deposits the funds elsewhere. System-wide deposits just rose by $300,000. The bank now carries an asset, Lena's mortgage, and a liability, the deposit until it is spent. To satisfy the rules, the bank holds capital against that risk and enough liquid assets to cover outflows during stress, so it can survive a rough patch. Basel's alphabet looks technical: LCR, NSFR, CET1. But the purpose is plain. The liquidity coverage ratio asks whether a bank could survive a modeled month of stress by selling cash-like assets. The net stable funding ratio asks whether long loans are funded with stable liabilities. CET1 capital asks whether owners have enough skin in the game to take losses before depositors are hit. These guardrails try to keep credit creation from turning into wildfire and from spreading across borders at speed. Still, the center of gravity is confidence. Imagine a regional bank starts to wobble. A few large depositors move funds. Screenshots circulate. Outflows accelerate. The bank sells bonds, but rising interest rates mean those bonds fetch less than face value, and losses eat into capital. Even a solvent institution can die of illiquidity if panic is fast enough. Deposit insurance and emergency lending are meant to break that feedback loop by guaranteeing small savers and lending against good collateral in a hurry. Why do cycles repeat? Because optimism and fear are human constants. In good seasons, risk feels smaller. Lenders relax, borrowers stretch, prices rise, and rising prices seem to justify even more borrowing. Then conditions shift, rates climb, incomes soften, and leverage that once looked efficient becomes a vice. That is not a moral failing. It is the structure of a world where money is manufactured as debt and growth depends on the pace of credit extension. So, when you glance at your balance, treat it as what it is: a claim produced by a bank's ledger, sustained by law, regulation, and trust. It is not counterfeit, but it is not a pile of cash either. The system was not built to maximize your independence. It was built to keep commerce turning and governments financed through cycles thick and thin. Understand the trick, and you can act on it. Keep a cushion, but do not confuse idle cash with safety. Use debt where it clearly builds durable capacity. Invest in assets and abilities that serve useful needs even when credit is scarce. Organize your life so that a tightening cycle does not force you into poor decisions at bad times or into selling valuable assets in a rush. Ignore the trick, and you will keep running in place as prices stride ahead of wages, wondering why each year feels a little tighter. If this helped reframe how you see money, hit subscribe. We will keep connecting history's mechanics to today's headlines, so you can navigate the system instead of being steered by it. One more lens helps. When central banks buy government bonds and programs called quantitative easing, they do not shower households with paper cash. They credit reserve accounts that commercial banks hold, swapping one safe asset for another. That can lower rates and lift asset prices, but it does not turn deposits into base money for the public. The private banking system remains the factory where most everyday money is stamped into being through loans. Another lens is deposit insurance. Guarantees reassure small savers that up to a limit their balances will be made good even if a bank fails. That promise deters panic runs, yet insurance does not print vault cash. If a large institution collapses, authorities still need rapid sales, bridge banks, or emergency funding to honor the pledge without sparking contagion. Confidence, again, is the lever that decides whether the backstop is tested. We should also separate solvency from liquidity. A bank can be solvent, assets exceed liabilities on paper, yet fail because it cannot turn assets into cash fast enough to meet withdrawals. Conversely, a reckless bank can seem fine while no one asks questions. Regulation tries to police both, but perception moves faster than audits. In a networked age, rumors can trigger flows in minutes, which is why supervisors now emphasize real-time monitoring and swift resolution playbooks. People ask, if banks create money from nothing, why can't everyone? A bank's IOU is special because law, central banks, and payment rails weave it into a system where its promises settle at par. You can issue an IOU to a friend. Shops will not accept it as money. A licensed bank's IOU is different because the state backs the architecture in which it circulates. For households, the takeaway is practical. Keep an emergency fund, map debts and fix rates where you can, so policy swings don't whipsaw your budget. Diversify stores of value across productive assets, education, and relationships. Ask of each borrowed dollar, does this increase my capacity to earn or reduce my fragility? If not, wait. If it builds durable capability, the leverage may be worth it. Policy can help at the margins. Stronger capital, clearer stress tests, and orderly wind-down tools do not change the fact that deposits are promises, but they can smooth the cycle and give people time to adjust when tides shift. If you made it this far, drop a plus in the comments, your badge for finishing the deep dive. And if you haven't already, subscribe for more long-form stories where money, history, and power collide. Curious about earlier empires of capital? Check out our others video.